I can't check. What is the SKS full போட்டு வச்சிரு. அது பெண்டிங் bills எல்லாம்
Hello, my dear students. A very good morning to all of you. I hope I am visible and audible. Can you please confirm either through chat box or through comment on YouTube that I am visible and audible? Yes, perfect. Thanks for your participation. Thank you. Thank you very much. Thank you. Yeah. So very good morning, my dear friends. A warm welcome to all of you for our CA Inter revision session. I would call it as an exam-oriented session, specifically focused towards your examination. And in this particular sessions, we are going to talk about holistically our entire syllabus. And this, in the morning session, we are going to talk about income tax. And later on, we'll talk about GST as well. But this particular session is for CA Inter income tax, which has got a weightage of 50 marks for your examination. So it is important that we get good clarity of thought and conceptual clarity. Now, I categorize students into three interesting parameters. Parameter number one, a student who is writing exam for the first time in the upcoming attempt. Second category of student is those who already wrote the exam in the previous attempt but could not crack through, maybe for various reasons, and student really knows what is that reason. Because see, ultimately, you being a student, you have written the exam, so you know very well what you have written and what you have missed out. More than any motivation, right now, I think what is required is beyond motivation, that conceptual clarity, which topic you are missing and where is that you are lacking. I think that is more important now beyond any motivation. Already you have got enough motivation with you. Clear? And the third category is set of those students who are writing for the first time, already done with the fundamental preparation. Everything is already intact, but they want a second round of revision so that they are totally clear with the concepts, what have been learnt, and also to ensure that they revise the amendments as well. Because I'm sure you all know that amendments of Finance Act 2024 are applicable for May 25, September 25, and Jan 26. For May 25 attempt, September 25 attempt, Jan 26 attempt, amendments of Finance Act 2024 are applicable for examination. So it is important that you guys get a hands hold on this amendment, and that hand holding is very much required. So during our session, chapter by chapter, whichever chapter there are amendments, I'm going to discuss all that amendments with you. If a student is asking me, sir, can I get all the amendments at one place? That's already there on our IndigoLearn YouTube channel. You can happily watch the all amendments at one place. If you want to go through all the amendments at once. But the objective of this particular sessions, what we are going to run for next 10 days is basically something like this. That topics like heads of income, clubbing, set off carry forward of losses, basic concepts, residential status, agricultural income, deductions, return of income. These are all the areas which are there for our syllabus. And we all know that 30% weightage is given for MCQs. And MCQs are not something where students will just try to go through MCQs, read all the MCQs and become perfect A, B, B, C, C. That's not how it works. MCQs are also pure conceptual oriented points. If you are clear with concept, any MCQ you can solve. See, last 4 or 5 attempt papers, we have discussed all the MCQs on our YouTube channel as well, where we clearly communicated what kind of MCQs are coming in the examination. Where if you do a small mistake, for example, let's say they give a question on computation of tax liability. Let's say you do the computation without surcharge and cess. You will get an answer. That answer will match with the options. Let's say you add surcharge, but you forgot cess. Whatever answer you get, that will match with the option. You add cess also, which is correct answer, that will match with the option. So that means if you do some mistake also, you will get some answer, and that answer will match with the options. That is where the real challenge is. Because the moment we find an answer in the options, we tend to get excited that, yes, we got correct answer. But that is the power of multiple choice questions, which you have to be very cautious and careful with. Clear, friends? So every day we are going to have 2 hours session. And in this 2 hour session, we are going to talk a lot about multiple aspects of income tax. So I want utmost participation. My only request to you on day 1 itself, that is, whenever you have any query or any doubt, feel free to comment in the chat box, or you can comment. I'll be more than happy to reply in your chat box. I'll reply your query for sure. There's no second thought about it. There is no doubt about it. Because the fundamental purpose of these sessions is to ensure that we get clarity of thought and become perfect, and we come out with flying colors in the examination with better numbers. That's the whole objective. And see, enter this taxation subject is very beautiful because income tax 50 marks, GST 50 marks. But when you go to CA final, income tax is 100 marks, GST is again 100 marks. So you know very well, being a chartered accountants, being future chartered accountants, right now we are future chartered accountants, and we are going to be chartered accountants very soon. You all know that taxation is one of the key subject for us where we cannot be any negligent. And we have to be very much perfect with this beautiful subject like taxation. Clear? So can I proceed with my subject? Very delay? Please reply. Yes, thank you. Just a second, let me share my screen. Can you please confirm that the screen is visible for all of you? Thank you, guys. Thanks for the participation. Thank you. Yeah. So, friends, first of all, let me tell you an interesting point. That is, the CA Inter income tax journey consists of topics like basic concepts, residential status. One of the very interesting topic. Generally, a question keeps coming in the examination from this topic. So one is basic concepts, residential status. And in this basic concepts, you have also discussion about something called agricultural income, where we are going to discuss the concept of partial integration. Then we have got a brilliant topic known as heads of income. Friends, what are the 5 heads of income? We have got income from salaries, income from house property, PGBP, capital gains, income from other sources. Come on, what are the 5? Number 1, salaries. Number 2, house property. Number 3, PGBP, profits and gains from business or profession. Number 4, capital gains. Number 5, what is number 5? Income from other sources, also known as a residuary head of income. So these are the 5 heads of income what we have got. Then, apart from that, we have got a topic known as clubbing of income. And the next very interesting and important topic, set off and carry forward of losses. And this topic known as set off and carry forward of losses generally keeps coming in the examination, because that is some topic where students tend to miss out some point and do some mistake in the examination. That is where Institute is asking this topic on and off. They're asking question from this topic of set off and carry forward of losses. Then, after that, we have topic known as deductions, and some very important topic known as advanced tax, TDS and TCS. Then we also have a topic known as return of income. Then finally, a topic known as computation of total income. So name only says computation of total income, where different multiple heads of income come together and we ask for computing the total income. Correct, right? Exactly. Yeah. So now, the interesting point to be noted here is, my dear friends, with respect to the amendments, we have got some interesting amendments in heads of income. We have got some interesting amendments in basic concepts because a lot of tax rates have got changed. And we have got some amendments in set off and carry forward of losses. We have got some amendments in deduction and many amendments in TDS and TCS. So if you observe carefully, in many topics, there are amendments. So we have to be cautious with those amendments. Clear with this, everyone? Done. Very good. So without delay, let me start the discussion, my dear friends. And today we are going to spend some good time on discussion about basic concepts. We're also going to spend some good time on discussion about residential status and scope of total income. Something important. So we'll spend some time there as well. Are we clear till this point? Can you please confirm? Yes, sir. Clear. Thank you. Come on. The first topic, what you're going to talk is, my dear friends, the basic concepts. And before I proceed further, one line I would like to tell is that I have prepared a summary material, easy summary material, a conceptual material for both income tax as well as GST. This will not work for a regular batch, but this is specifically designed for exam-oriented revision batch. Purely from an examination standpoint, what all are required to be covered, that is what we have discussed in this particular thing. Are we clear? Done. What I will do is, I'll also attach that file here. Yeah. Anyways, looks like I'm unable to attach the file, but I'll still share that file in the group with all of you. Don't worry. We already have our WhatsApp groups. In that, I'll share this document with all of you. Don't worry. Okay? Done. So let me start the discussion, guys. The first topic what we are going to talk is, my dear friends, the basic concepts. Of course, an important discussion to be done. First of all, my dear friends, what is tax? We all know that tax is a compulsory fee which is charged by the government. We always say the word compulsory fee charged by the government because it's not an option. We are obligated to pay tax to the government. Government is a partner with us in our income. If we are making 100 rupees, government has got some share of their share in our income, what we get. Correct? So tax is a fee charged by the government on any product, service, income, wealth, or activity. And we have got examples like sales tax, service tax, wealth tax, excise duty, export duty, import duty. But we know that a lot of indirect taxes have been consolidated into one nation, one tax known as GST, which stands for Goods and Services Tax. And in tax, my dear friends, we have got two types of taxes. That is direct tax and indirect tax. And students tend to use a basic language like direct tax is levied directly, indirect tax is levied indirectly. That's not acceptable at all. The language is not that, my dear friends. Direct tax is a tax where impact and incidence. These are the two interesting words what we see for both direct and indirect tax. What are the words we see? Impact and incidence. Impact means who is liable to pay. Incidence means who actually pays. Come on, what does impact means? Impact means who is liable to pay. Incidence means who actually pays. In case of direct tax, impact and incidence is on same person. And in case of indirect tax, impact and incidence is on different person. For example, Shiva Teja is earning income. On the income what I earn, I am only required to pay income tax. So I'm earning the income and I'm only required to pay income tax. So income tax is clearly a direct tax because impact and incidence is on same person. But let me tell you, Shiva Teja, I'm a chartered accountant in practice. I provide services to various clients. When I'm providing services to various clients, along with the bill, I'm also charging something known as GST, which stands for Goods and Services Tax. Actually, who is liable to pay GST is the Shiva Teja is only liable to pay GST. I repeat again, who is liable to pay GST is Shiva Teja is only liable to pay GST. But I collect the GST from my customer because I'm doing something called shifting of tax burden. What is it I'm doing, my dear friends? Shifting of tax burden. This concept of shifting of tax burden is allowed only in case of indirect tax, but not in case of direct tax. It is allowed in indirect taxes because indirect tax is a tax where impact and incidence is on different person. Person who is liable to pay, person who actually pays, both are not one and the same. But in case of direct tax, person who is liable to pay, person who actually pays, both are one and the same. I'm sure we are getting clarity on this point, everyone. Good. So what are the words you have to use? Impact and incidence. Direct tax is a tax where impact and incidence is on same person. Indirect tax is a tax where impact and incidence is on different person. Next. These taxes are the basic source of revenue to the government, and the revenue so raised is utilized for meeting expenses of the government in relation to defense, education, healthcare, infrastructure facilities like roads, dams, etc. That is the reason why whenever we walk on the road, sometimes where some road construction work is going on, they put up a board. Your taxes are at work. Your taxes are at work. They put that board because they are doing that infrastructure development out of the taxes what we pay to the government. So this tax what we pay is a basic source of revenue to the government. Getting the point, everyone? Exactly. Next. Constitutional authority. What is the word, my dear friends? Constitutional authority. Constitution in Schedule 7 has enumerated matters on which central government can make laws are divided into three categories. There are three lists known as union list, state list, concurrent list. So the difference is that union list contains those matters. Union list contains those matters on which central government has got power to levy taxes. Example, income tax. State list contains those matters on which state government has got exclusive power to levy taxes. And last one is called concurrent list. Concurrent list contains those matters on which central and state together will take the decision. In fact, once upon a time in India, I'm telling once upon a time because I'm talking about the scenario prior to 2017. So once upon a time in India, there were some taxes which were levied only by central government. And there were some taxes which were levied only by state government. But there was never a tax levied by central and state together. But for the first time in the history of India, in the year 2017, they brought an interesting tax known as GST, which stands for Goods and Services Tax, which is levied by both central and state together. Prior to that, there were some taxes levied by center, there were some taxes levied by state, but there was never a tax levied by center and state together. Are we getting clarity, everybody? Yes. As I told you already, direct tax is a tax where impact and incidence is on same person. Indirect tax is a tax where impact and incidence is on different person. So in exam, please don't go and write the word direct tax is levied directly, indirect tax is levied indirectly. Don't use all that language, please. Make sense, right? Yeah. Next. Structure of Indian income tax. Friends, in order to learn Indian income tax, I repeat once again, in order to learn Indian income tax, my dear friends, there are 5 important sources. I repeat again, there are 5 important sources in order to learn Indian income tax. And the 5 important sources are Income Tax Act 1961, Income Tax Rules 1962, Annual Finance Act, Circulars and Notification, and last one is Judicial Pronouncements. So see here, first point. Central government has been empowered by entry number 82 of Union List of 7th schedule to the Constitution to levy tax on all income other than agricultural income. On agricultural income, there is no tax directly, but indirectly there is a concept known as partial integration through which they are collecting some tax. How I'll discuss that with you separately. Today only I'll tell you that, don't worry. Come on. So the 5 sources of income tax law are: number 1, Income Tax Act 1961. Number 2, Income Tax Rules 1962. Number 3, Annual Finance Act. Annual Finance Act of which year? The basic logic, this comes every year. And how does this come into picture? Every year, budget is presented on the first day of February. And this budget will become finance bill when it is approved by both houses of parliament. And once it is signed by president, it becomes Finance Act. And for students who are writing exam in May 25, September 25, Jan 26. For these 3 attempt students, the applicable Finance Act is 2024, not 2025. And when I say applicable Finance Act is 2025 for you, applicable Finance Act is 2024 for you, the previous year will be 24-25. Assessment year will be 25-26. For your examination, previous year will be 24-25. Assessment year will be 25-26. Are we getting clarity on this point? Now, I'm sure I don't need to discuss with you what is the meaning of this word called previous year and assessment year. We are very close to the examination. Previous year is nothing but the year in which income is earned. Previous year is the year in which income is earned. Assessment year is the year in which previous year income is chargeable to tax. Come on. What is previous year? Previous year is the year in which income is earned. Which year you earn the income, that year is called previous year. And which year that income is chargeable to tax, that is called assessment year. And for examination of May 25, September 25, Jan 26, previous year will be 24-25, assessment year will be 25-26. Are we clear till this point? Can you please reply? I want utmost participation, guys. Kindly please don't relax. This session is for you. So ensure that you get the best out of this. So what is the previous year for examination? For the exam, previous year will be 24-25. Assessment is what? 25-26. Good. Yes. Very good. That should be the participation. I love this. Good enough. Come on. So friends, what are the 5 sources of income tax law? Number 1, Income Tax Act 1961. Number 2, Income Tax Rules 1962. Number 3, Annual Finance Act, which comes every year through a way of budget, and the budget becomes finance bill when it is approved by both houses of the parliament. And this finance bill will become Finance Act once it is signed by the president. Next, circulars and notifications. These circulars and notifications are given by an authority known as CBDT. And this CBDT stands for Central Board of Direct Taxes. The rules and regulations are enacted by CBDT, and in fact, this is CBIC now for indirect taxes, Central Board of Indirect Taxes and Customs. And for income tax, it is CBDT, Central Board of Direct Taxes. And finally, last one is judicial pronouncements of High Court or Supreme Court, which is nothing but case laws. At CA inter level, you don't have case laws in your syllabus, but at CA final level, you will learn a lot of interesting case laws, my dear friends. Clear? Done. So friends, what are the 5 sources of income tax law? The 5 sources of income tax law are Income Tax Act 1961, Income Tax Rules 1962, Annual Finance Act, Circulars and Notifications, and the last one is Judicial Pronouncements. Come on, friends. What are the 5 sources? Repeat again. Number 1. Come on, what is number 1? Income Tax Act 1961. Then Income Tax Rules 1962. Annual Finance Act, Circulars and Notifications. And the last one is Judicial Pronouncements, which is nothing but case laws given by the High Court or Supreme Court. Next. Assessment year, previous year. Assessment is defined by Section 29 of Income Tax Act. Previous year is defined by Section 3 of Income Tax Act. Assessment year is the year in which return of income for previous year ended is filed. It always starts from 1st April and ends on 31st March. Next. Previous year is the year in which income is earned. I already told that to you. In fact, this word previous year is actually defined by Section 234 and Section 3. Why two sections are there? Because Section 234 says previous year means previous year as defined in Section 3. Section 234 says previous year means previous year as defined in Section 3. That's a crazy point. So yeah, come on. It is the year in which income is earned. All previous year, whether first or subsequent, shall always end on 31st March. However, the start of previous year will depend on existence of source of income. It's an important point, friends. So let us say, for example, one person, Mr. A, he started business on 10th August 2024. Then what will be his previous year, my dear friends? The previous year will be 10th August 24 to 31st March 2025. And assessment year will be 1st April 25 to 31st March 26. And this is the reason why we always say assessment year is always 12 months. Previous year need not always be 12 months. Because if business is commenced in the middle of the year, then previous year will be less than 12 months, my dear friends. That's the reason why we say this dialogue called previous year is less than 12 months. It can be less than 12 months, but assessment year is always 12 months. Are we clear till here? Can I proceed? Done. Thank you very much. Thank you. Yeah. Coming back to the discussion. So we have discussed what is previous year, what is assessment year. Come on, friends. What are the 5 sources of income tax law? Income tax in 1961, income tax rules 1962, annual finance act, then circulars and notifications. The last one is judicial pronouncements, which is nothing but case laws of High Court or Supreme Court. Then previous year defined with section. Previous year defined by Section 234 and Section 3. Previous year means the year in which income is earned. And assessment year is defined by which section, my dear friends? Come on. Assessment year is defined by Section 29, and assessment year is always 12 months, and assessment year will always come after the previous year. Yeah. Now I'll ask you one question. Think properly and tell the answer. Friends, let's say, for example, I write here the word financial year 25-26. Is it previous year or assessment year? Come on, did you get my question? I wrote the word financial year 25-26. Is it previous year or is it assessment year? That's my straight question to you. Now, my dear friends, for previous year 24-25, assessment year will be 25-26. And for previous year 25-26, assessment year will be 26-27. That is the reason why we always say that every financial year, come on, what is the word I'm saying, sir? Every financial year will act as both previous year and assessment year. I repeat once again, what is the line I just told? Every financial year will act as both previous year and assessment year. That's an important point to be noted, friends. Good. Very good. Coming back to the discussion. Come on, next an important word, assessee. But in the word assessee, this word is important. In GST law, we use the word taxpayer, registered person and all. But in income tax, we use the word assessee. But first of all, before we learn assessee, you will find an interesting line here. Assessee means a person. You are able to observe that word? Assessee means a person. Now, big question is, who is that person? Who is that person? Let's see who is person first. Person includes an individual, HUF, company, firm, a local authority, AOP, in fact, POI as well. Come on, person word is defined by section 231, which clearly says person includes individual, HUF, company, firm. Firm also includes LLP, my dear friends. Individual, HUF, company, firm, LLP, local authority. Local authority is something like municipal corporation, my dear friends. Next, AOP or BOI. AOP stands for Association of Persons. BOI stands for Body of Individual. Then every AJP stands for Artificial Juridical Person. Classic example, ICAI, Institute of Chartered Accountants of India. If I ask you, my dear students, please show me ICAI. You can show me ICAI building, but you can't show me ICAI. Because ICAI is not a natural person. It's an artificial juridical person. Clear? So person includes what? Individual, HUF, company, firm, LLP, local authority, AOP, BOI, as well as AJP. Now coming back to discussion, who is an assessee? Section 27 talks about who is an assessee. A very, very important definition came in exam sometimes. So please watch out very carefully. Assessee means a person by whom any tax or any other sum of money is payable under the Act. Come on, who is assessee, my dear friends? Assessee means a person by whom any tax or any other sum of money is payable under the Act, and includes every person in respect of whom any proceedings, what is that word, sir? Any proceedings under the Act have been taken for assessment of his income or assessment of income of any other person or loss sustained by him or such other person or refund due to him or such other person. Why such other person? Such other person in respect of whom he is assessable. This is an important line. I'll tell you why. So let us say there is a person, Mr. Shiva Teja. Okay. Now, this person, Shiva Teja, is liable to pay income tax. The moment I use the word Shiva Teja is liable to pay income tax, Shiva Teja is regarded as an assessee under income tax law because I'm liable to pay some tax. Next, second situation is, even though I'm not liable to pay any tax, if income tax department has given some notice to me, then also I'm regarded as assessee, because the first word is used is every person in respect of whom proceedings have been taken up for assessment of his income or income of any other person, or loss sustained by him or such other person, or refund due to him or such other person in respect of whom he is assessable. Meaning of the point is what? I'll give a classic example, my dear friends. Let us say there is Shiva Teja's son who is a minor. I repeat that word, my dear friends. There is Shiva Teja's son who is a minor. Now, in respect of minor income, we know the provisions of income tax law, which talks about something known as clubbing. If minor earns income without skill and talent, Because if minor earns income with his own skill and talent, then the provisions of clubbing will not apply. But if minor does not earn income with his own skill and talent, then definitely provision of clubbing will apply. That means what? For the income earned by Shiva Teja's son, who is minor, income will be clubbed in the hands of Shiva Teja only. And in respect of income earned by Shiva Teja's son, who is assessable is Shiva Teja only. Because as per clubbing provision, income of a minor child will be clubbed in the hands of that parent whose income is higher. Clear with this point, everybody? Good. Come on. See the first point again. Every person in respect of whom proceedings under that have been taken up for assessment of his income or assessment of income of any other person or loss sustained by him or such other person or refund due to him or such other person in respect of whom he is assessable. Second word. Every person who is deemed to be an assessee. So name only says deemed to be an assessee. Deemed is something like assumed. See, for example, you are sitting at home preparing for examination. No other work in life right now except for studying. Because the only objective is passing of CA intern. Nothing else. Correct or not? Exactly. Now, when the only objective is passing of CA intern, nothing else, my dear friends, imagine a situation like this where you are sitting at home. You are telling your parents, I'll go to my bedroom. I'll lock the door. Next 3 hours, I'll only study, fully study. I'll lock the door from inside. Don't disturb me at all for next 3 hours. You went inside and you lock the door. Now you tell me what you are doing inside, only you know, your phone knows. That's it. But outside, the parents who are sitting, they assume that it is deemed that you are studying. That is the meaning of this word called deemed. Clear? Next. Every person who is deemed to be an assessee under that. Example, representative assessee, like agent of non-resident or guardian of minor, etc. In case of non-resident, the agent will be responsible, my dear friends. Then, a person who is deemed to be an assessee in default under any provisions of the Act. This word assessee in default is an interesting language. I'll show you 3 important points there. Number 1, assessee in default, first point, person who fails to deduct TDS. That means person who has not done the TDS. So TDS stands for tax deducted at source. We have got various sections like TDS on salary, TDS on rent, TDS on professional, TDS on commission, TDS on interest, 192, 193, 194, 194A, 194B. So many sections are there for TDS as such. He has failed to do TDS. He is liable to do TDS, but he has not done the TDS. Second situation. Person who after deducting tax fails to pay such tax. When I say fails to pay the tax to whom? Government. So first scenario is TDS not done. Second scenario is TDS done but not paid to government. Come on, what is the first scenario? TDS is not done at all. What is second scenario? TDS is done but not paid to government. And finally, last point, person who does not pay tax or advance tax. Person who failed to pay tax or failed to pay advance tax. Advance tax, I'm sure you know that it is required to pay tax in installments. And we have got 4 installments given in the law. That is 15th June, 15th September, 15th December, 15th March. 15th June, by this date, you are required to pay 15% of estimated tax payable. 15th September, 45%. 15th December, come on, December, how much, friends? Please tell. Come on, participate, reply. 15th September is 45. 15th December is how much? Very good. 15th December, 75%. 15th March, 100%. These are the installments of advance tax what you are required to pay. And in case of failure to pay this advance tax, you are regarded as assessee in default. What is it we are going to call them, my dear friends? We are going to treat them as assessee in default. Are we getting clarity on the spot, everybody? A very, very important definition as to who is an assessee, which is defined by section 2.7, my dear friends. Friends, an important section. Which section? 2.7. Assessee means what? Come on. Assessee means any person who is liable to pay tax and includes what, my dear friends? And includes every person in respect of whom proceedings have been taken up for assessment of his income or loss or refund related to him or any other person in respect of whom he is assessable. Next, number 2, every person who is deemed to be an assessee, deemed assessee. And the last one is assessee in default. Assessee in default covers 3 scenarios. I repeat again, assessee in default covers 3 situations. Situation 1, person who has not done TDS. Number 2, person who has done TDS but not paid to government. Number 3, person who failed to pay tax or advance tax. Very, very important definition. High possibility that question will come in the examination. So which section defines assessee? 2.7. Simple terms, who is covered here? Any person who is liable to pay tax. Second situation, every person in respect of whom proceedings have been taken up. Next, every person who is deemed to be an assessee. And every person who is regarded as assessee in default. And assessee in default covers 3 cases: who has not done TDS, who has done TDS but not paid to government, who has failed to pay advance tax. Getting clarity, everybody? That's it. That's the story of this very, very important section, section 2.7. And I hope we are very clear with this. Kindly please reply and confirm. Can I proceed? Yes, thank you. So friends, come on. Section 2.7 defines who is an assessee. 2.9 defines what is assessment here. 231 talks about who is a person. 234 is previous year. Section 3 is also previous year, my dear friends. And we have got an important section known as section 4, my dear friends, which is basically the chargeability section of income tax, which clearly says income earned by an assessee during the previous year shall be chargeable to tax in assessment year. Come on, what is that line, my dear friends? Income earned by an assessee during the previous year shall be chargeable to tax in the assessment year. That means whatever income is earned in the previous year, that will be chargeable to tax in the assessment year. We already learned who is an assessee. We already learned what is previous year. We already learned what is assessment year. Now let's learn what is the meaning of this word called income. This word income is defined by section 224, my dear friends. And income includes dividend, profits and gains, profits in lieu of salary, capital gains. Capital gain is gain what we get from sale of a capital asset. A very important chapter. High possibility question will come in the examination. Next, winning from lottery crossword puzzles, which we technically call it as casual incomes. Any sum chargeable to income tax under section 28. 28 is the chargeability section for PGBP, which we'll learn in PGBP, my dear friends. Next, any assistance in the form of subsidy or grant or incentive or wayback, drawback or waiver or concession will be taxable as income. It will be taxable regardless of the fact whether subsidy or grant is received from central government, state government, or any other authority or body. It will be taxable whether it is received in cash or in kind. Getting the point? And let me tell you one interesting line. If subsidy is related to capital assets, then value of such subsidy shall be reduced from cost of asset. What is that line, friends? Value of subsidy shall be reduced from cost of asset. Next. That means if you purchase asset for 10 lakhs, let us say you got subsidy as 1 lakh. Then the cost of asset you will show in the books is only 9 lakhs. This is important because ultimately you are going to charge depreciation based on cost of asset only. Come on, next. Income tax is a revenue law, and only revenue receipts are taxable and not capital receipt. Friends, there is always a golden rule of income tax which clearly says that all revenue receipts are taxable. All revenue receipts are taxable unless exempt. And all capital receipts are exempt unless specifically taxable. And what is revenue receipt? Revenue receipt is what we get from a source. Revenue receipt is what we get from a source. Capital receipt is what we get by losing a source. For example, if you have a property, let's say some house property we are having. From that property, we are getting some rental income. I repeat again, from a property, we are getting some rental income. So that rental income is regarded as a revenue receipt. But imagine a case where we sold the property. We sold the property and we got some money. Then that is regarded as a capital receipt. Rental revenue receipt is what we get from a source. Capital receipt is what we get by losing a source. Are we getting clarity? Now, in the same lines, I'll also discuss with you what is the meaning of this word capital expenditure and revenue expenditure. Capital expenditure, it is not deductible from income. It is usually a non-recurring outlay. It makes improvements in earning capacity of the business. That is why we always say capital expenditure enhances the value and life of assets. It produces benefit for several years. It is incurred in acquiring, extending, improving a fixed asset. For example, compensation given for a contract, amount spent in connection with license. Revenue expenditure, it is incurred in the ordinary course of business. It is consumed within 1 year. It is in normal course of business only. That's why we always say, if you talk about a word called repair expenditure, whether that repair expenditure is capital or revenue, it clearly depends upon the nature of expenditure, what you have incurred, and for what purpose you have incurred that expenditure. And what is that repair you have done using that money. Are we clear, my dear students? Good, fair enough. Thank you. Next. General rule. As already told you, section 4, income of the previous year is chargeable to tax in assessment year. What is that word, my dear friends? Income earned by an assessee during the previous year, it will be chargeable to tax in the assessment year. Income earned by an assessee during the previous year, that will be chargeable to tax in the assessment year. But for this rule, my dear friends, there are exceptions. Exception means what? Basically, exception means which are against the basic rule. And what is the basic rule? Income earned by an assessee during the previous year shall be chargeable to tax in the assessment year. That's the basic rule. And there are some exceptions to the basic rule, means there are some points where basic rule will not apply. Basic rule will not apply. What does that mean? Income earned by assessee during the previous year shall be chargeable to tax in the previous year itself. Generally, what is the rule? Income earned by an assessee during the previous year is chargeable to tax in assessment year. But there are 5 exceptions for this point, my dear friends. Number 1, shipping business of non-resident. And in this case of shipping business of non-resident, my dear friends, let me tell you for your knowledge, 7.5% of turnover is deemed to be profit. What is that word, sir? Shipping business of non-resident. And who is this person called? Non-resident. Non-resident is somebody who does not satisfy basic condition under section 6.1. There are two interesting basic conditions, and I'm sure you know that. He must be in India for a period of 182 days or more during the previous year. Or he must be in India for a period of 60 days or more during the previous year and 365 days or more during the 4 years preceding the relevant previous year. If any of these conditions is satisfied, we'll treat him as resident. If both are not satisfied, we treat him as non-resident. So what is the first exception here? Shipping business of non-resident, section 172. Next, number 2, section 174, person living India. When I say person living India, permanently or for a long time, actually, not temporarily. Permanently or for a long time. Generally, this word is not defined in the law, but for your knowledge, common sense, you have to apply. Long time generally means more than 1 year. Because if it is less than 1 year, he will definitely come back in assessment year. If he's coming back in assessment year, then why will you force him to pay tax now only? You might get one doubt. So what if he doesn't come back? There is nothing like that. Whenever you go to foreign country, you are required to take something called visa. That visa has got a validity. Let's say your visa is for 6 months. After 6 months, even though you don't want to come, they'll throw you out. Clear, everyone? Good. So the first one, shipping business of non-resident. Number 2, section 174, person living India permanently or for a long time. Next one. AOP, BOI, AJP. What is AOP? Association of person. BOI, body of individual. In BOI, everybody is individual. But if an individual, a company and firm come together, we call it as association of person. AOP, BOI, AJP formed for a particular event or purpose. Technically, we call it as short duration or purpose. And when I say short, the meaning is common sense, less than 1 year. So what is section 172? Shipping business of non-resident. Section 174, person leaving India permanently or for a long time. Section 174A, AOP, BOI, AJP formed for short duration or purpose. Next line, persons likely to transfer property to avoid tax. He has got one house property with him. He is transferring that property to someone in order to avoid the tax. If government is of the opinion that you are trying to sell one property in order to avoid the tax, they will tell boss, this transaction will be void, and moreover, I will not wait till assessment year. You pay tax now itself. And the last one is discontinued business, section 176. And let me tell you one point more for your knowledge. In first 4 cases, 172, 174, 174A, 175, in the first 4 cases, AO shall, assessing officer shall, that means AO will collect the tax in the previous year itself. But in last case, they use the language AO may. That means there is an option given to assessing officer. So what are the 5 points, friends? First one, section 172, shipping business of non-resident. Next, section 174, persons leaving India permanently or for a long time. Then section 174A, AOP, BOI, AJP formed for short duration or purpose. Then 175, persons likely to transfer property to avoid tax. And the last one, section 176, discontinued business. So these are the 5 exceptions to the chargeability section. And the chargeability section is section 4, which clearly says income earned by an assessee during the previous year shall be chargeable to tax in the assessment year. That is a point. Are we clear? Yes, please reply. Yes, very good. Thank you. Yeah, next. Further, in case of cash credit. So cash credit means there is some credit in the bank account, but you are unable to explain the source of that credit. In case of cash credit, unexplained investment, income tax government has done some search or income tax rate, they found some documents and they're asking where from you got money to purchase this property. You are telling somewhere I got. You're unable to explain. Then that is called unexplained investments. Unexplained money, investment not fully recorded. Unexplained expenditure, amount borrowed or repaid on hundi. So hundi is basically a negotiable instrument drawn in local language. That is called hundi. So getting the point, everybody? Come on, what is that word, sir? Amount borrowed or repaid on hundi. Otherwise through an account pay check. So this word is important. Account pay check. Law never uses the word cross check, bearer check, and all. The word used is account pay check. There's a difference between the word cross check and account pay check. See, cross check also will draw 2 lines. Account pay check also will draw 2 lines. But the fundamental difference is that cross check can be transferred from one person to another person. That means cross check can be endorsed. But this account pay check cannot be endorsed. Come on. Amount borrowed or repaid on hundi, otherwise through an account pay check. If no satisfactory explanation is provided, then the amount is deemed as income of the previous year of discovery. And let me tell you, these unexplained incomes, unexplained investments, unexplained money, unexplained expenditure, amount borrowed or repaid on hundi, otherwise than through account pay check. These all cases, my dear friends, income tax rate is very, very high. And let me tell you, the income tax rate is directly 60%. And in fact, it is 60% plus surcharge 25%. Plus HEC 4%. I am sure you know what is surcharge. Surcharge is an additional tax over and above the normal tax. And HEC stands for Health and Education Cess, which is always 4%, my dear friends. And that is the reason why we always say the effective rate is 78%. How? 60% is the basic rate. And surcharge is 25%. 25% is on 60. 25% on 60 is 50. 25% on 60 is 15. Total is 75. Next, we'll take 4% on 75, which is 3. That is why it is 78%. Came in MCQ couple of times. So in case of unexplained incomes, unexplained investments, unexplained expenditure, amount borrowed or repaid on hundi, otherwise than through account pay check, in all these cases, the rate of tax is governed by section 115BBE and the effective rate of tax is 78%. So done, clear? Friends, reply please. Done, good. Come on, friends, what is section 27? 27 defines who is an assessee. 29 assessment year. 224 income. 231%, 234 previous year, section 3 previous year, section 4 chargeability section. And for chargeability section, we have got 5 exceptions, my dear friends. Section 172, shipping business of non-resident. 174, person leaving India permanently or for long time. 174A, AOP, BOI, AJP formed for short duration or purpose. 175, person likely to transfer property to avoid tax. 176, discontinued business. These are the 5 interesting exceptions to chargeability section. Done. Computation of total income and tax liability for assessment year 25-26. How is that we are going to compute total income, my dear friends? As we all know, we have got 5 heads of income, that is salaries, house property, PGBP, capital gains, other sources. All 5 heads of income combined together, we call it as gross total income. And from gross total income, we reduce something known as deductions under Chapter 6A. And once we reduce that, what we get is called total income. And this total income is rounded off as per section 288A. Which clearly says it is rounded off to nearest multiple of 10. That means if it is 64,582, we'll make it as 64,580. If it is 64,587, we'll make it as 64,590. That means if last number is 5 and above, we'll round off to next 0. If it is next to 10, if it is less than 5, we'll round off to previous 10. So all 5 heads of income combined together, what we get is called gross total income. From gross total income, we'll reduce what? Deductions given by Chapter 6A, 80C to 80U, like life insurance, medical insurance, interest on housing loans, interest on educational loans. So many points are there. Yeah. Once we reduce deductions, what we get is called total income, which we rounded up as per section 288A. And on that total income, my dear friends, we'll compute the tax, reduce rebate if any. We'll discuss what is that rebate. We'll add HAC, surcharge also if it is applicable, total tax liability. We'll reduce TDS, TCS. TDS is tax deducted at source, TCS is tax collected at source. Advance tax, also self-assessment tax. The balance will be net tax liability rounded off as per section 288P. And this rounding off concept is also same. That is rounded off to a nearest multiple of 10. That's it. Are we clear with this, everybody? Now comes the most important discussion of this first topic, basic concepts, my dear friends. That is computation of tax liability. Other words, tax rates. Sir, in case of individual, HUF, AOP, BOI, AGP. In case of individual, HUF, AOP, BOI, AGP. Friends, you have got 2 options. Option number 1, you can pay tax as per a default tax regime given by section 115 BAC, or you can opt out of default, which is called optional tax regime. Wherein the tax rates are given by Finance Act. Come on, friends. I repeat once again. For individual, HUF, AOP, BOI, AJP, you have got 2 options. Number 1, you can go for a default tax regime, which is given by section 115 BAC. Or you can go for an optional tax regime. That means you can shift out of default tax regime and go for optional tax regime. Student is asking, sir, which one is better? My straight answer is, it depends. It depends. Why? Listen carefully here. In default tax regime, my dear friends, tax rates are less, but many deductions are not allowed. So I repeat once again, what is that word I wrote, sir? The tax rates in default tax regime is less, but many deductions are not allowed. So how a person should, what a person should do is, the person must compare and then decide. Compare and then decide. In exam, what we should do? Listen very clearly. If question is silent, solve as per both. Next situation. If question specifies 115 BAC, then solve as per default. Sometimes question will tell optional tax regime, normal tax regime, or they'll use the word opt out of default. Opt out of default. Getting my language, my dear friends? In all these cases, you have to compute as per the normal taxes. Getting my point, everybody? Which one is better? It clearly depends upon what kind of deductions you're having, what deductions you're not having. Based on that only, we are going to take a decision which tax regime is better for us. Clear with this point? Come on, get back. Very, very important discussion. Kindly please concentrate. Individual HUF, AOP, BOI, AJP, default tax regime given by 115 BAC of Income Tax Act. Very, very important section, my dear friends. Come on, see here. Up to 3 lakhs, the tax rate is nil. But before that, I'll tell you one important point. There is no category of normal, senior, and super senior. There is no category called normal, senior, super senior. Directly, the tax rates are given. Clear? What are the tax rates? Come on. Up to 3 lakhs, it is nil. 3 lakhs to 7 lakhs, it is 5%. In the previous attempt, in the previous, before Finance Act 2024, it was 3 lakhs to 6 lakhs. But now it has become 3 to 7. 3 to 7 lakhs, it is 5%. 7 lakhs to 10 lakh, it is 10%. 10 to 12 lakhs, 15%. 12 to 15 lakhs, 20%. Above 15 lakhs, 30%. Observe the tax rates very clearly, my dear friends. Up to 3 lakhs, what is the answer? Come on, friends, up to 3 lakhs, what is the answer? Up to 3 lakhs, the tax rate is 5%. 3 to 7, the 3 lakhs, the tax rate is 0. 3 to 7, 5%. 7 to 10, 10%. 10 to 12, 15%. 12 to 15, 20%. Above 15 lakhs, 30%. These are the interesting tax rates in default tax regime, my dear friends. Are we clear? Please reply. Good, 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 good. Come on. What is the answer, friends? Up to 3 lakhs? What is the answer? Come on. To 3 lakhs, it is nil. 3 to 7, 5%. 7 to 10, 10%. 10 to 12, 15%. 12 to 15, 20%. Above 15 lakhs, 30%. I'll ask you one question. Please answer properly, friends. Assume for a second, income is 17 lakhs. Compute tax, friends. Come on. Quickly do it. Quickly do it, 2 minutes time. Get me the answer. If income is 70 lakhs, compute the tax, come on. Should I ask inside default? Of course, default. That is what I'm teaching you right now. Please do it. Different answers are coming. So what is that income I specified? 17 lakhs is what I told you, correct? If it is 17 lakhs, please tell me up to 3 lakhs. What is the answer? Nil. 3 lakhs to 7 lakhs, 5%. That means on 4 lakhs, it is 5%. 4 lakh, 5% will come to how much, my dear friends? 20,000. 7 lakhs to 10 lakhs, it is 5%. I mean, 7 lakh to 10 lakh, it is 10%. 7 lakh to 10 lakhs is 10% means how much it comes to, my dear friends? 30,000. 10 lakhs to 12 lakhs, 15%. That means 2 lakhs, 15%, again 30,000. 12 lakh to 15 lakhs, 20%. On 3 lakh, 20%, which comes to 60,000. Greater than 15 lakhs, 30%. Greater than 15 lakhs is 2 lakhs. 2 lakh, 30% is 60,000 again. So what are the total, guys? 20 plus 30, 50, 50 plus 30, 80, 80 plus 60, 140, 140 plus 60, which comes to 2 lakhs. That's it. Some student told 1,20,000. I don't know how do you get that figure. 2,08,000 is okay. That is acceptable because on this 2 lakh, we'll add something called HEC, which is nothing but health and education at the rate of 4%. Perfect. I hope we are clear with this working, everybody. Yes, please. Good. But the story does not end here. Please listen. Please carefully concentrate. We need to understand when default is good, when optional is good. Come on, please see here. See, option to opt out of the scheme shall be exercised by individual or HUF having income from business or profession on or before the due date specified under 139(1) for furnishing return of income, and option once exercised shall apply for subsequent year. However, he can only once withdraw such option and pay tax under default tax regime, and thereafter he shall never be able to exercise the option of opting out except when he ceases to have business income. And if he is having income other than income referred above, along with return of income for previous year, he may choose to pay tax under a default in 1 year and option to shift out in another year. That means what? 2 situations I will tell. Situation 1, not having business income. If you don't have business income, then what is the answer? 1 year default, 1 year optional. 1 year default, 1 year option. Whenever you want, you can switch in, switch out, switch in, switch out, switch in, switch out. We just have to opt at the time of having return of income. But if having business income, then what they told in the law is, if you are in default, you want to shift out of default and come to normal, you can pay tax in normal, no problem. But you are telling, no, I'm not liking normal, I will go back to default. You can go back to default one time. Then once you go back to default again, after that, you will never be able to opt out of default, my dear friends. That means only one time exit and entry is allowed. After that, you cannot exit. Only one time only exit and entry is allowed. Post that, you can't do anything, my dear friends. Are we clear with this? Good. Fair enough. Come on. The total income is computed without the following exemptions or deductions. That means the following are not allowed if you are paying tax under default tax regime. Number one, leave travel concession under section 10(5), interest under section 24 in respect of self-occupied property. 24B deduction is not allowed for self-occupied property. HRA under 1039, additional depreciation, allowances contained in 1014 like children education allowance, children hostel allowance, transport allowance, all these are not allowed. Various deductions for a donation or expenditure on scientific research covered in section 35. Allowances to MPs or MLAs covered in 1017. Deduction under 35 AD for specified business. Cold chain facility, warehousing, agriculture, produce, all this is not allowed. Allowance for income of minor contained in 1032. 1032 gives deduction, some exemption is given for in case where minor income is clubbed in the hands of parent. Exemption will be income clubbed or 1,500, whichever is lower per child. That much exemption is given. Next, any deduction under chapter 6A except 80CCD2. 80CCD2 is employer contribution to pension scheme of central government. Next, central government contribution towards Agnipath scheme under section 80CCH2. This is a part of initiative of Agnipath scheme notified for army professionals, army persons. And 80JJAA deduction in respect of new employment, my dear friends. That case also it is not allowed. So if you observe carefully, if you are paying tax under default tax regime, you cannot take any deduction under chapter 6A except 80CCD2, 80CCH2 and 80JJAA. ACCD2, 80CCH2 and 80JJAA. These are only allowed. Other than this, no other deduction of chapter 6A is allowed if you are paying tax under default tax regime. Next, exemption for SEZ unit contained in section 10AA. 10AA talks about exemption for SEZ unit, wherein first 5 years you get 100%, next 5 years 50%, and next 5 years again 11 to 15 years 50%, depending upon amount transferred to SEZ reinvestment reserve account. Then 16.2 and 16.3. 16.2 is basically your entertainment allowance. $16.3 is your professional tax. These are not allowed if you are paying tax under default tax regime. So if you observe carefully, if you are paying tax under default tax regime, you can't take all these deductions. That's the reason why tax rates are less. How less? I will show you. Don't worry. And while computing total income, any exemption or deduction for allowances or perquisite by whatever name called, provided under any other law for time being in force in India would not be allowed. And while computing total income, set off of any loss, carry forward or depreciation from earlier years, if loss or depreciation attributable to any of the deductions referred above, under the head house property with any other head of income. HP loss cannot be set off with any other head of income in case you are paying tax under default tax regime. So I'll tell you the correlation between HP loss and default tax regime. This is important, friends. So let us say, situation 1, you are paying tax under default. Situation 2, you are paying tax under optional. First point, 24B. 24B. For let out property. It is allowed in default also, allowed in optional also. 24B. For self-occupied property. It is not allowed in default, but allowed in optional. HP loss with HP income. It is allowed in default also, allowed in optional also. HP loss set off with other income. Default case, the answer is not allowed. Come on, friends. Default case, what is the answer, my dear friends? Default case, the answer is not allowed. But in optional case, my dear friends, it is allowed to the extent of 2 lakhs. And the balance can be carried forward. This is actually the correlation between HP loss and the tax regimes, my dear friends. Good. A student is asking, sir, explain the depreciation point or two. My dear friends, let me tell you, if you observe that point very clearly, you cannot claim additional depreciation. Normal depreciation may be allowed, but additional depreciation is not allowed. Normal depreciation can be claimed, but you can't claim any additional depreciation. And if any loss comes because of additional depreciation, you can't set up that as well. If you're paying tax under default tax regime. Are we clear till this point, everyone? Please reply. Also, the depreciation point and set off. My dear friend, same logic. The set off also, what I'm trying to tell you is that set off of any loss, which is carry forward or depreciation one year, if the loss or depreciation is attributable to deductions referred above. That means additional depreciation you can't take. And if any loss comes because of additional depreciation, that also you can't set off. Technically, we call it as unabsorbed depreciation. Yeah. Student is asking, sir, can you please explain once again the last point, sir? So last point, what I'm trying to tell you is that house property loss set off with other income. If you are paying tax under default tax regime, you cannot set off house property loss with some other income. But if you are paying tax under optional tax regime, you can set off house property loss with some other income only to the extent of 2 lakhs. And the balance can be carried forward. I'm sure you are clear with this, my dear student. Yes, are we done? Come on, going back. Optional tax regime. Individual, HUF, AOP, BOI, AJP, below the age of 60 years. And also non-resident individual irrespective of his age. That means if a person is a non-resident, irrespective of age, he will always come under first category only. That means even though he is a senior citizen, he will still come under first category only. And what are the tax rates in first category? Up to 2.5 lakhs nil, 2.5 to 5 lakh 5%, 5 to 10, 20%, about 10, 30%. These are the basic tax rates which is there from ages together. The same story is there. 2.5 lakhs nil, 2.5 to 5 lakh 5%, 5 to 10, 20%, about 10, 30%. Same story. If you are senior, 60 and above, but less than 80, 2.5 becomes 3 lakhs, rest all is same. 80 and above, up to 5 lakhs nil, 5 to 10, 20%, about 10, it is 30%. Come on, friends. I'll give one question. Please solve. One person, Mr. X, his gross total income is, let us say, 12 lakhs. Deduction under section 80C is 1 lakh. And deduction section 80D is 30,000. House property loss under 24B for self-occupied is 2 lakhs. Clear? Now, my question to you is, compute the tax under default and optional. Come on, friends, do the working. Get me the answer. Compute under default also, optional also. I'll give you 2 minutes time. Please get the answer. Yes, friends, did you get the answer? Come on, friends. Default, you'll compute tax on what, my dear friends? First point, you'll compute tax on 12 lakhs only, my dear friends. Why will you compute tax on 12 lakhs only? Because you can't take 80C, 80D, 24B. All this is not allowed. So on 12 lakhs, what is the tax that will come into picture? So 3 lakhs it is nil. 3 lakhs to 7 lakhs it is 5%. 4 lakhs 5% is how much, my dear friends? 20,000. 7 lakhs to 10 lakh at the rate of 10%. 3 lakh 10% is 30,000. And 10 lakhs to 12 lakh at the rate of 15%. 2 lakh 15% is 30,000. 30 plus 30 plus 20 is 80,000. On that, we'll add HEC at the rate of 4%, which is 3,200, which comes to 83,200. Good. Many students got right answer. Very good. But what about optional, my dear friends? Come on, tell me. If it is optional, we'll compute tax on what figure, my dear friends? We'll compute tax only on 8,70,000. Correct or not? Why? Because I will take ATC reduction, I will take ADT reduction, I'll also take house property loss set off. This GTA before 24B, don't worry. I'll come to tax on 8,70,000. If it is 8,70,000, what is it I'm going to do, my dear friends? Come on. To 2.5 lakhs, nil. 2.5 lakhs to 5 lakh, 5%, which comes to 12,500. 5 lakhs to 8.7 lakhs at the rate of 20%. That means 3.7 lakhs, it is 20%, which comes to 74,000. 86,500. %4 comes to 3,460. 3,460 plus 86,500. 89,960. 89,960. You tell me, my dear friends, in this example, which one is better? Default is better or optional is better? Definitely default is better. So please don't shift out of default. So what is better clearly depends upon which deductions you are getting, which deductions you are not getting. It's not a thumb rule to tell always that this is only better, that is only better. It clearly depends upon what deductions you're able to claim, what deductions you're not able to claim. Can I proceed happily? Yes, please. Now, let me talk about some very important concept that is called rebate under section 87A. Results. In case of default, in case of optional. In case of default, they have specified that rebate is applicable only to a resident individual whose total income does not exceed 7 lakhs. And the rebate will be tax payable or 25,000, whichever is lower. Tax payable or 25,000, whichever is lower. And in case of optional, rebate is applicable to a resident individual whose total income does not exceed 5 lakhs. And here the rebate is tax payable or 12,500, whichever is lower. Tax payable or 12,500, whichever is lower. Are we getting clarity? Let me discuss one small example so that full clarity will come. Let us say one person, Mr. X, he is an optional. Total income 4,30,000. If it is 4,30,000, how do I calculate tax, my dear friends? After 2.5 lakhs, nil. And 2,50,000 to 4,30,000 at the rate of 5%. That means on 1,80,000, 5%, which is coming to 9,000 rupees, my dear friends. But law is telling if you are a resident individual and if your total income does not exceed 5 lakhs in optional tax regime, then we'll give you something called rebate. And that rebate is tax payable or 12,500, whichever is lower. So rebate will be 9,000 and the tax payable will become nil. In exam, one crazy dangerous student wrote rebate is 12,500, balance figure is 3,500 refund. So you will not get refund out of rebate, boss. How will refund come out of rebate, my dear friends? Don't do that crazy mistakes in the examination. Next. Other side. Mr. A. He is paying tax under default. Total income is 6,50,000. How do we calculate tax, my dear friends? Up to 3 lakhs, it is nil. 3 lakhs to 6,50,000 at the rate of 5%. Three lakh 50,000, 5% is coming to 17,500. From that, I will reduce rebate under section 87A, 17,500. The balance tax payable will be nil. So friends, 87A rebate in case of default tax regime is applicable to resident individual whose total income does not exceed 7 lakh rupees. And the rebate is tax payable or 25,000, whichever is lower. And in case of optional tax regime, rebate is applicable to a resident individual whose total income does not exceed 5 lakh rupees. And there the rebate is tax payable or 12,500, whichever is lower. I'm pretty sure you're getting clarity on this point. Yeah? Okay, good. But some special point I'll tell you, which is there in default tax regime. Special point, which is there in default tax regime. Sir, assume for a second, Mr. X is at a default tax regime and he is a resident individual. I repeat again, he is under default tax regime and he is a resident individual. Come on, friends, what did I say? He is under default tax regime and he is a, what, my dear friends? Resident individual. Come on, friends. First of all, again, I'm asking the question. In case of default tax regime, what is the story, my dear friends? Rebate is applicable to a resident individual whose total income does not exceed 7 lakh rupees. And rebate is tax payable or 12,000, tax payable or 25,000, whichever is lower. And in case of optional taxation, what is the rebate? It is applicable only to a resident individual whose total income does not exceed 5 lakh rupees. And the rebate is how much? Tax payable or 12,500, whichever is lower. And please do keep in mind that this rebate is always reduced before HEC. Student is asking the doubt, said, do I reduce this rebate before HEC or after HEC? Rebate is always reduced before HEC only, my dear friends. There is no second thought about it. There is no doubt about it. Are we clear with this? Come on. What is that I'm trying to tell you here? I'm trying to tell you one special point, which is there only in default tax regime. So let us say income is 7,15,000. If it is 7,15,000, how do I calculate tax? Up to 3 lakhs, it is nil. 3 lakhs to 7 lakh, 5%, 20,000. Correct, no friends? 3 lakhs to 7 lakhs is 5%, which comes to how much? 20,000. Then greater than 7 lakhs, 10%. 15,000, 10% is 1,500. Yes or no? Total figure is how much? 21,500. Now you tell me, I will ask you one straight question. If his income would have been exactly 7 lakhs. I repeat once again. If income would have been exactly 7 lakhs. If income would have been exactly 7 lakhs, what would have been the tax? The tax would have been 0. I repeat again, if income would have been exactly 7 lakhs, the tax would have been 0. Result of special point very clearly. If income would have been exactly 7 lakhs, the tax would have been 0. But now, what is the income? But what is the income? The income is 7 lakhs 15,000. That means it is slightly more. Correct, no friends? What is the extra income beyond that 7 lakhs limit? Extra income beyond 7 lakhs limit is 15,000 rupees. Friends, correct or not? Everybody. That means what is happening here? You are actually getting 15,000 extra. You are getting how much money? 15,000 extra. Because of which you are paying 21,500. Law is telling, no, we'll not trouble you like that. We'll not ask you to pay more than extra what you got. Correct? That's where they told, don't worry, still I will give you rebate under section 87A. And that rebate will be 21,500 minus 15,000, which comes to 6,500. And on this 15,000, we'll add HSA at the rate of 4%, which comes to 600, 15,600. This special story will come only when the tax what you get is more than that amount exceeding 7 lakhs. That is the story. So imagine if the tax is not 21,500. So let's say tax is 21,500 and extra income beyond 7 lakhs is 23,000. Then this rebate will not work. Are we getting clarity on this point? An interesting concept, but applicable for your examination. Student is asking, so the last point is not clear. My dear friend, let me explain to you once again. Please listen carefully. Sir, here, this special point is only in default tax regime. Okay. Mr. X is in default tax regime. His income is 7 lakhs 15,000. 7 lakhs 15,000. 1.5. Now I'll ask you one question. What would have been the tax if income would have been exactly 7 lakhs? If income would have been exactly 7 lakhs, my tax would have become 0 because of rebate. Now, because it is 7 lakhs 15,000, my tax has come to 21,500. My extra income beyond 7 lakhs is only 15,000. My extra income beyond 7 lakhs is only 15,000. But my extra tax, what I'm paying is 21,500. Law is telling, I'll still give you rebate, which is your extra tax minus your extra income. It is something like the concept of marginal relief, what you apply in surcharge. In surcharge, you would have heard about something called marginal relief, right? Same concept here. Are you clear with this, my dear friend? Please reply. Everybody, are we clear? Can I proceed? Please reply. Student is asking, sir, what if the amount is 7 lakhs 39,000? Let's check. No problem. Don't worry. Let's check, my dear. Let's check. 7 lakhs 39,000. You tell me, how do I calculate tax? Up to 3 lakhs, it is nil. 3 lakhs to 7 lakh, 5%, which comes to 20,000. And on 39,000, we'll apply 10%, which is 3,900. Total is 23,900. And other side, income beyond 7 lakhs is 39,000. Correct, no? So my straight answer, no rebate. Obviously, no rebate. Because the rebate story will come only if your income tax is more than the extra income beyond 7 lakhs. If your income tax is more than the extra income beyond 7 lakhs, then only we'll get rebate. I hope your question is solved. I'm sure your question is answered, my dear friend. Very good. Thanks for the participation. Thank you. Come on, going back, friends. Rebate, I just discussed with you, both in case of default tax regime and also in case of optional tax regime. In case of default tax regime, what is the story, my dear friends? Rebate is applicable to resident individual whose total income does not exceed 7 lakh rupees, and the rebate is tax payable or 25,000, whichever is lower. And in case of optional tax regime, rebate is applicable to resident individual whose total income does not exceed 5 lakhs, and the rebate is tax payable or 12,500, whichever is lower. That's it. That's the end of story for rebate, and that's the end of story for tax rates for individual HUF, AOP, BOI, AJP. And before I complete this, I'll proceed to surcharge rate for individual HUF, AOP, BOI, AJP. Come on, please see there. If total income is more than 50 lakhs but does not exceed 1 crore, my dear friends, surcharge rate will be 10%. More than 1 crore does not exceed 2 crores, surcharge rate is 15%. More than 2 crores, not more than 5 crores, it is 25%. More than 5 crores, it is 37%. But in default, you will not find the word 37, you will find only 25. That means in default, only 3 possibility. More than 50, not more than 1, 10%. More than 1, not more than 2, 15%. More than 2, it is 25%. That's it. But in optional, what is the story? More than 50, not more than 1, 10%. More than 1, not more than 2, 15%. More than 2, not more than 5, 25%. More than 5, 37%. Such a high surcharge rate because government follows system called progressive system of taxation. Higher income, higher tax, lower income, lower tax. But you see below one line, if total income includes any dividend or any income chargeable under section 111A, 111A, 112 and 112A. 111A is short-term capital gains, 112 is long-term capital gain, 112A is long-term capital listed securities. The surcharge on the amount of income tax computed on that part of income shall not exceed 15%. In other words, surcharge higher than 15% is applicable only on tax on income other than dividend and capital gains. So on dividend and capital gains, we can't apply 25%, 37%. We'll apply only 15%. So for tax on capital gains, on that we'll apply 15% only as the surcharge rate. We can't apply 25 and 37. Getting clarity? Next. In case of AOP consisting of only companies as members, then you have only 2 categories, 10%, 15%. You don't have 25 and 37. That's it. Coming back to the discussion. That's the end of story for individual HUF, AOP, BOI, AJP, guys. So I'll ask you one question. Please think properly and tell the answer. Solve actually. Mr. A, an individual, he is under default tax regime. Income is 65 lakhs. Come on, friends, please compute tax quickly and tell the answer. Only 2 minutes time. Very quickly, I want the answer. Good. Some answers started coming. But the tragedy is different answers have come. Guys, come on. I'm talking about which regime? Default tax regime is what I'm talking. And the income what I gave there is 65 lakhs. Come on. How do we do the working? Up to 3 lakhs, what is the answer? Nil. 3 lakhs to 7 lakhs, 5%, which comes to 20,000. 7 lakhs to 10 lakhs, 10%, which comes to 30,000. 10 lakh to 12 lakh, 15%, again 30,000. 12 lakh to 15 lakh, 20%, which comes to 60,000. And above 15 lakhs, 30%. That means on 50 lakhs, 30%, which comes to 15 lakhs. 20 plus 30 plus 30 plus 60 plus 16 lakhs, 40,000. So that I will add surcharge at the rate of 10%, 1,64,000. 18 lakhs, 4,000. HEC at the rate of 4%, 72,160. 1876, 160. This is what is the figure what I got. If anything is wrong, please tell me. If I went wrong or you went wrong, please tell me. Some are telling 17 lakh 5,600. How did you get 17 lakhs 5,600, friends? Can you please tell how you got 17 lakhs 5,600? Somebody? Oh, they have taken surcharge as 5%. Why, my dear friend? More than 50 lakhs, not more than 1 crore, surcharge is 10%. And some of them didn't add surcharge only. Wow. See, these mistakes prove costly in the exam days. These are the mistakes that prove very costly in the examination, which you have to be careful with. Clear? Can I go back? Yeah, thank you. Come on, my dear friends. Next, looking at, so please be careful with the surcharge rate. 10%, 15%, 25%, 37%. Default, you have only three possibilities, 10, 15, and 25. And for dividend and capital gains, we are not going to charge 25 and 37. We'll charge only 15%. Highest, not more than that. Are we clear with this, everyone? Please be cautious. Next. Tax rate for firm, LLP, local authority. For firm, LLP, local authority, tax rate is directly 30%, my dear friends. And surcharge also is very simple. More than 1 crore, directly 12% is the surcharge. No further discussion. Next. Cooperative society up to 10,000, 10%. There is no nil here. Nil is not there. Don't get confused. Nil is not there. So 10,000, 10%. 10,000, 20,000, 20%, about 20,000, 30%. I repeat again, up to 10,000, 10%, 10,000, 20,000, 20%, about 20,000, it is 30%. And for surcharge rate, cooperative society, more than 1 crore, not more than 10 crores, 7%, more than 10 crores, 12%. In fact, this is same like domestic company actually. Come on, companies will see tax rate. Domestic company, we are talking tax rates for assessment year 25-26. Correct? No? I already told you for the examination, it is AY 25-26. For your exam, it is clearly AY 25-26. So for AY 25-26, if the turnover in the previous year 22-23, that is what we have to see. We have to see previous year 22-23. If turnover in the previous year 22-23 does not exceed 400 crores, then the tax rate is 25%. Any other case, the tax rate will be 30%. And surcharge will be total income more than 1 crore, not more than 10 crores, 7%, more than 10 crores, 12%. Next. Other than domestic company, that means what? I'm talking about the surcharge rate in case of, or tax rates in case of foreign company. In case of foreign company, the tax rate is directly, small correction here, the tax rate is directly 40%, my dear friends. 40%, yeah, but your examination will be 35 only, as per your ICAI material. Yeah. 35%, but for royalties and fees for technical services, it is 50%, my dear friends. So high tax rate. 50%. But for 50%, the agreement must be entered between 1/4/1961 to 31st March 1976 in case of royalties, and 1/3/64 to 31st March 1976 in case of FTS. FTS stands for fees for technical services. And since the tax rate itself is so high, the surcharge rate is little less, my dear friends. So the surcharge rate in case of foreign companies, more than 1 crore, not more than 10 crores, it is 2%. More than 10 crores, it is 5%. So, in simple terms, the rate of surcharge in case of companies goes like this. Number 1, domestic. Number 2, foreign. Total income more than 1 crore does not exceed 10 crores. Total income more than 10 crores. Domestic it is 7%, 12%. Foreign company it is 2%, 5%. Foreign company surcharge rate is less. Obviously, the reason because already the tax rate is so high. That is why they kept the surcharge rate little lower. Are we getting clarity on this point? Everyone? Good. Friends, the story does not end here. We still have a long way to go. Today was just the first session, just a trailer of the picture which we are yet to see. So there is a long way to go, my dear friends. So next 10 days, I want your utmost concentration, utmost focus. We have a lot of things to learn. So I want your utmost concentration and become perfect, my dear friends. Any doubts, feel free to message us. Feel free to type in the chat box. I'll be more than happy to reply to your queries. And the session done doesn't mean that the topic is over. You have to revise. Subsequently, you have to revise. Student asking, sir, residential status. We'll do that in next session, my dear friend. Don't worry. Next session, we'll do residential status. Clear? Student asking, sir, what all chapter we are going to cover tomorrow? We'll cover residential status, and we'll cover that concept of agricultural income. And if time permits, we will see a small head of income like house property or other sources. We'll see. Based on time, we'll take a decision. Should I asking, sir, what about notes? You'll get the notes, don't worry. Mostly by end of today or by tomorrow, you'll get the notes. Okay, we'll share the PDF with you. I'm sure you guys enjoyed the session today. Thank you so much, guys. Thank you. See you all in the next session. Thank you. Take care. Bye-bye.